Good debt versus bad debt. Meet David and Lisa, both 28 years old with identical incomes. David believes all debt is evil and pays cash for everything. Lisa understands debt as a financial tool. 5 years later, David is still middle class while Lisa is building serious wealth. Here's what happened. David saved $50,000 over 3 years and bought one rental property with cash. He felt proud being debt-free. Lisa took that same $50,000 and used it as down payments on 5 rental properties, financing the rest with mortgages. Fast forward 5 years. David's one property appreciated from $50,000 to $70,000, a $20,000 gain. Lisa's 5 properties appreciated on their full purchase prices, not just her down payments. Her properties went from $250,000 total value to $350,000, a $100,000 gain. But it gets better. David collects rent on one property. Lisa collects rent on 5 properties, generating 5 times the monthly cash flow. Lisa used good debt to multiply her returns, while David's fear of debt limited his growth. Good debt helps you acquire assets or increase your earning potential. Mortgages on cash-flowing rental properties, student loans for degrees that boost your income, business loans that grow profitable companies. This debt literally pays for itself over time because the asset generates more income than the debt costs. Bad debt finances consumption and depreciating assets. Credit card debt for vacations you can't afford, car loans for vehicles beyond your means, personal loans for furniture and gadgets. This debt makes you poorer because you're paying interest on things that lose value or provide no financial return. Here's the strategy that wealthy people use. Eliminate bad debt aggressively, while strategically using good debt to build wealth. If your rental property mortgage charges 4% interest, but you can earn 8% in the stock market, keep the mortgage and invest the difference. Let someone else's rent payments pay down your debt while your money grows elsewhere. Assets versus liabilities. This single concept will completely rewire how you think about money. An asset puts money in your pocket every month. A liability takes money out of your pocket every month. Sounds simple, but most people get this backwards. Meet Marcus, who thought buying a $60,000 BMW was building wealth. Every month, Marcus pays $800 for the loan, $300 for insurance, $100 for gas, and $50 for maintenance. That's $1,250 flowing out of his pocket monthly, while the car loses $15,000 in value the first year. Marcus bought a $1,250 monthly liability disguised as success. Now meet Jennifer. She bought a reliable used Honda for $8,000 cash, then used the money she would have spent on BMW payments to invest in a duplex. She lives in one side and rents the other for $1,500 monthly. Her mortgage payment is $1,200, so she makes $300 every month while building equity. Jennifer turned what most people see as an expense into an income-generating asset. That's the difference between asset thinking and liability thinking. Your primary residence isn't automatically an asset either. If you live in it, and it costs you money every month through mortgage payments, taxes, insurance and maintenance, it's a liability. But if you rent out rooms and collect more than your total housing costs, then it becomes an asset. The wealthy focus on acquiring assets that generate cash flow. The middle class focuses on acquiring liabilities they think make them look successful. This mindset difference creates completely different financial outcomes. Investment account types. This is where most people lose thousands in unnecessary taxes because they don't understand the rules. The government created different account types with specific tax advantages, but you need to know which one to use when. Meet twins Sarah and Mike, both 25 years old, earning $60,000 annually. They both invest $5,000 yearly for 40 years in the same index funds, earning 8% returns. The only difference? Sarah uses a Roth IRA, while Mike uses a traditional taxable account. At retirement, Both have invested $200,000, but Sarah's Roth IRA is worth $1,300,000 tax-free. Mike's taxable account is also worth $1,300,000, but he owes taxes on every withdrawal. At a 22% tax rate, Mike effectively has $1,014,000, $286,000 less than Sarah. Same investments, same returns, but Sarah understood tax-advantaged accounts while Mike didn't. Here's how each account type works. A 401k is your employer-sponsored retirement account. You contribute pre-tax dollars, reducing your current taxable income. If you earn $60,000 and contribute $6,000 to your 401k, you only pay taxes on $54,000 this year. But here's the catch: you pay taxes when you withdraw in retirement. The bet is that you'll be in a lower tax bracket when you retire than you are now. Many employers offer matching contributions, which is free money. If your employer matches 50% up to 6% of your salary and you don't contribute, you're literally refusing a raise. Traditional IRA works similarly to 401k. You get a tax deduction now, but pay taxes on withdrawals later. You can contribute up to $6,500 annually if you're under 50, $7,500 if you're over 50. Roth IRA are the opposite. You contribute after tax dollars, so no immediate tax deduction. But here's the magic. Everything grows tax-free forever. Your contributions, your gains, your withdrawals in retirement, completely tax-free. Here's why Roth IRA are powerful for young people. Let's say you're 25 and in a 22% tax bracket. You contribute $5,000 to a Roth IRA, paying $1,100 in taxes on that money now. That $5,000 grows to $43,000 by retirement. In a traditional IRA, you'd pay taxes on the full $43,000 at withdrawal, potentially $9,460 in taxes. With the Roth, you paid $1,100 in taxes up front and saved $9,460 later. That's an $8,360 difference on just 1 year's contribution. HSA are the ultimate tax-advantaged account if you have a high deductible health plan. You get a tax deduction for contributions, tax-free growth, and tax-free withdrawals for medical expenses. It's the only account with triple tax advantages. But here's the secret. After age 65, you can withdraw HSA money for any purpose and only pay regular income taxes, just like a traditional IRA. So max out your HSA, invest the money instead of spending it on small medical bills, and you've created another retirement account with better tax treatment than anything else. Credit utilization strategy. Most people think paying credit cards to zero every month maximizes their credit score. That's wrong. And this mistake costs thousands in higher interest rates on mortgages and loans. The optimal credit utilization is 1 to 10% of your total credit limits when statements close. If you have $10,000 in total limits, maintain balances totaling $100 to $1,000 when statements generate, then pay them off before due dates. Why this works? 0% utilization suggests you don't use credit at all. 30% or higher suggests financial stress. But 1 to 10% demonstrates responsible credit management to scoring algorithms. Here's the advanced strategy. Use one card for small recurring bills like Netflix and Spotify. Let it report a small balance and keep others at zero. This creates perfect utilization ratios across your entire credit profile. Dollar cost averaging. This strategy transforms market volatility from your enemy into your wealth-building ally. Instead of trying to time market peaks and valleys, you invest fixed amounts consistently regardless of market conditions. Consider Emma, who invests $500 monthly starting in January. In January, shares cost $50 each, so she buys 10 shares. In March, markets crash and shares drop to $25. While everyone panics and sells, Emma's $500 now buys 20 shares. By year end, Emma accumulated more shares at a lower average cost than if she'd invested $6,000 all at once in January. Market crashes became buying opportunities instead of reasons to panic. House hacking. This strategy lets regular income earners become real estate investors without massive capital. You buy a small multifamily property, live in one unit and rent out the others. Meet Jake, a teacher earning $45,000 annually. Traditional investment properties require 25% down payments he couldn't afford, but he qualified for a duplex as his primary residence with just 3.5% down through FHA financing. Jake bought a $300,000 duplex with $10,500 down. He lives in one side, rents the other for $1,500 monthly. His total mortgage payment is $2,000, so his housing cost is only $500 while building equity. After 1 year, Jake moved out and rented his side for $1,500 too. Now he collects $3,000 monthly rent against a $2,000 mortgage. That's $1,000 monthly cash flow from a $10,000 investment. Tax write-offs. These legal deductions reduce your taxable income, but most people miss massive opportunities because they don't understand business expense rules. Sarah runs an online jewelry business, earning $30,000 profit annually, but pays minimal taxes through strategic deductions. Home office deduction, vehicle expenses for business use, equipment and supplies, all legitimate deductions that reduced her taxable income from $30,000 to $18,000, saving over $3,000 in taxes. Risk management. Disability insurance is more critical than life insurance for young people. You're statistically more likely to become disabled than die, and disability destroys finances faster than death. Umbrella insurance provides lawsuit protection for about $300 annually. But the biggest risk management tool is multiple income streams. Diversify income like you diversify investments. These concepts separate those who build lasting wealth from those who struggle financially forever. The education system teaches you to be an employee, but financial education teaches you to build wealth-generating systems. Understanding these fundamentals gives you the same knowledge wealthy people use to multiply their money, while others wonder why they can't get ahead.